All right, let's get right into it. You've probably heard a million times that if you want market-like returns, well, you just have to accept market risk. But what if that wasn't the whole story? What if there was a strategy that gave you the chance for growth tied to the stock market, but without that constant fear of losing your hard-earned money when things go south? I mean, that's the big promise, right? The idea that you can sidestep those brutal market downturns that we've all seen, or at least heard horror stories about. Honestly, it sounds almost too good to be true. And that's exactly what you should be asking. How on earth can you get a piece of the upside without being exposed to all of that terrifying downside? Well, the answer isn't in a direct investment. It's in a financial strategy. Okay, so let's break it down. The strategy we're talking about is called Indexed Universal Life, or IUL for short. And the very first thing you need to grasp is that this operates in a totally different universe than your typical 401k or brokerage account. Okay, so here's the absolute key. It's a life insurance strategy. Your money, it isn't actually in the stock market. It's held safe and sound by the insurance company. It then gets credited interest based on how an index, like the S&P 500, performs. Your original money, your principal, is never directly at risk. So how does that protection actually work? This is the most important piece of the puzzle, the real engine behind this whole thing. I want you to think of it like a vault. Your core funds, the money you put in, are kept inside the insurance company's general account. They're completely insulated from the wild day-to-day swings of the stock market. Your money is not on that roller coaster. And this is the secret sauce. This brings us to the most powerful safety feature. In a year where the market index that the strategy is tracking goes down, and I don't care if it's down 10%, 20%, or even 40%, the minimum interest your account can ever be credited is zero. Not negative 40, zero. And this is the perfect way to remember it. In the IUL world, zero is your hero. It's the floor, it's the safety net that prevents your account value from ever going backward because of a market crash. You just get a zero for the year, you hold steady, and you wait for the next upswing. Okay, that makes sense for protection. But if your money isn't actually in the market, how does it grow? I mean, where are the gains coming from? So here's the play-by-play. First, like we said, your principal is safe, period. Then, the insurance company takes a tiny slice of its own money. Now that's a key point. It's their money, not yours, and it buys options on an index like the S&P 500. If the index goes up, those options pay out, and boom, your account gets credited with gains. But if the market tanks, the options just expire worthless. The insurance company might lose a tiny bit on that bet, but your principal, it's completely untouched. You're simply measuring the market's performance, not risking your money in it. Now, this all sounds pretty amazing, but with anything in finance, there's always a trade-off, right? You can't have zero risk and get 100% of the market's home runs. And that brings us to something called a cap. And this slide just lays it all out perfectly. With direct investing, sure, your upside is unlimited, but so is your downside. You could lose it all. With an IUL strategy, your upside is limited by that cap, let's say it's 10% for the year, but your downside is completely wiped out by that 0% floor. You're basically trading some of those potential peak returns for complete and total protection from losses. So what does this actually look like in the real world over time? Let's take a look at how this strategy can give you a really powerful advantage, especially when the markets get choppy. I want you to think back to this incredibly turbulent time. I mean, we had the dot-com bust, a really slow recovery, and then, of course, the huge global financial crisis in 2008. So many people saw their retirement accounts get absolutely crushed, not just once, but twice in about a decade. So let's just visualize one of those big crashes, like a 40% drop. The direct market investor sees their portfolio get slashed. They're now facing years, maybe even a decade, of just trying to get back to where they started. But the IUL holder? They just get a zero. Their principal is 100% intact, ready for the next move up. And this right here is probably the most critical takeaway of this entire concept. It turns out that avoiding the losses is way more powerful than chasing the biggest winners. When the market finally turns around, the IUL holder's growth starts from their previous high point. They are not digging out of a massive hole. They are building on a solid foundation. Okay, so let's pull all these threads together. Let's just summarize the key advantages this strategy might offer for someone who's really thinking seriously about their retirement. You really get 4 major benefits here. First, that absolute principal protection with the 0% floor we've been talking about. Second, you still get that potential for growth linked to the market. Third, there's flexibility.
You can often choose between a fixed interest rate or the index strategy each year. And finally, and this is a huge one for retirement, if it's set up the right way, the income you can take from the policy later on can be completely tax-free.
And when it's all said and done, it really comes down to a fundamental choice. It's about your financial philosophy and, frankly, what helps you sleep at night when you're planning for your future. So which path are you on? Are you on path A, willing to risk big losses for that shot at hitting a massive market home run? Or are you on path B, preferring to protect your principal at all costs, and you're happy to accept solid, consistent, capped gains in exchange for never, ever going backwards because of a market crash? It's all about your priorities, and that choice is what really defines your path to a secure retirement.